End of a long week of economic data is trying to break back into the green this morning, up about a tenth of 1%. We're looking pretty good 30 minutes into the start of trading. I'm Sonali Basak.
And I'm Danny Berger. Matt Miller and Katie Greifeld are off. Bloomberg Open Interest starts right now.
And coming up, the case for a cut. Fed Governor Chris Waller says private sector hiring is driving his call for a rate cut. And streaming success. Netflix blew past estimates last quarter, but investors still aren't impressed. And a big victory in big oil. Chevron wins its arbitration fight with Exxon, clearing the way for it to buy Hess, Danny.
And we start right there, Sonali. A clear market reaction this morning. Both Chevron and Hess shares on the rise following that 3.6%, 7.6% respectively. The $53 billion deal was announced more than 20 months ago. Chevron CEO Mike Wirth says this merger of two great American companies brings together the best in the industry. And Sonali, we will be speaking with the CEO later. Really looking forward to that conversation.
And from big oil to big tech, we're looking at Netflix today. It is down about 2.4% pre-market. Results beat expectations in every major metric, and it raised its forecast. But that wasn't enough, given that the stock has soared almost 50% from its April low. Netflix executives are looking to the future. The company says that they look to ramp up spending on gaming while providing creators with new tools to enhance films.
We remain convinced that AI represents an incredible opportunity to help creators make films and series better, not just cheaper. There are these AI-powered creator tools. So this is real people doing real work with better tools. Our creators are already seeing the benefits in production through pre-visualization and shot planning work, and certainly visual effects.
For more on Netflix, we are joined by Bloomberg Technology co-host Ed Ludlow. Ed, a beat across every metric.
Right.
Shares down 2.3%, though.
Yeah, it's a simple story of a beat that is not as grand as the great expectations of Wall Street. You know, a lot of the sell side are particularly focused on the ad-supported tier, right? The revenue from that ad tier is going to double in this calendar year. But it's also a stock that's up, 43% so far year to date. It has a $500 billion market cap, eclipsing all of those sort of legacy stalwarts of the media space, Disney being the most obvious example. So Netflix has been saying for a really long time, Wall Street, please judge us on these sort of historic financial metrics. And on all of those metrics, it did a really great job. The content slate looks good, but it's just a standard. I'm really sorry, Danny. I feel like you're like rolling your eyes over there in New York going, come on, spill the tea here. But there isn't any tea to spill. It's just simple expectations against delivery.
Okay, I get a kick here, Ed, out of Morgan Stanley's reaction from earnings, because I think it says something about the rest of big tech earnings. They say that Netflix's early but growing use of Gen AI tools to power content and product innovation would reinforce their bullish view. Does that mean that Wall Street is going to get excited about the investment in AI for the rest of earnings season, or are valuations just too high to support that view, even if people are bullish?
Think so. Really interesting to kind of demarcate the infrastructure play from software companies. Netflix is basically a software company, right, that still needs to evidence some top-line growth that directly results from investments in AI. The use of AI in Netflix's case is really interesting because the sell side this morning is also saying, okay, actually, we look at the content slate for the second half of this year, it looks great. Squid Game 3, I've just watched the finale 2 nights ago, fantastic. You have Happy Gilmore 2. Those pieces of content are known to be in the works and will be coming. But what happens thereafter? You have to feed the beast kind of thing is how I'd summarize the analyst notes this morning. And there's not yet evidence that AI technology is feeding the pipeline. But if they say that it will, then I guess the street takes them at face value.
Ed, we thank you so very much. We're looking forward to the rest of earnings season with you. Of course, that is Ed Ludlow of Bloomberg Technology. Looking forward to your show as well. Chevron now also, as Jenny had been talking about, won its arbitration battle with ExxonMobil, clearing the way for its $53 billion deal to buy Hess. The decision ends a period of limbo, 20 months of limbo, that hurt Chevron stock and prompted questions over the quality of the company's due diligence when it agreed to buy Hess 2 years ago. Joining us now with more details, Simon Casey, Bloomberg's managing editor for energy and commodities. Deal's done, right? I mean, what does this mean in terms of the ability to squeeze out that dollar to bring back what was lost over the last 20 months?
Well, I mean, must be sighs of relief all round at Chevron this morning. As you say, this has been going on for a while. This has been, as you said, an overhang on Chevron stock. The stock has underperformed. It's just sheer uncertainty over the past 20 months, the inability for Chevron to do very much except hang on, wait for this arbitration deal. So now, excuse me, you have analyst notes coming out this morning that the streets are saying Chevron get on with integrating these assets, boosting its earnings, focusing on Guyana, which is a very, very promising oil play. Exxon's been there for some time. Interestingly, Chevron and Exxon are going to be working side by side on this joint venture off the coast of Guyana. So how does that go on? There's a lot of love lost there. Some bitterness, I would imagine. Something to ask Mike Wirth later on today. This has been a real problem for Chevron the past 20 months.
Well, it's also a Chevron that's been trying to engineer restructuring, that's also been letting go of employees, trying to cut costs. What does it mean to be integrating Hess at a time when they're trying to do this and make sure that things stay in line, again, especially when it comes to cost pressures?
Look, I mean, I think they're raring to go. The deal closed today. They'll get on. They'll do that. Yeah, the cost cuts that you mentioned, the cost savings over the last several months, I mean, that's part of an ongoing process. We've seen that at Exxon as well across the industry. The post-pandemic oil industry in the US has been laser focused on costs. The integration process now will be reasonably straightforward. Hess's assets, half their revenue comes from Guyana, the rest is from largely from the Bakken shale field here in the US. Chevron will integrate those assets pretty quickly. It already has a very big shale footprint here in the US. It's a very experienced operator.
Yeah, we'll see how two enemies in the legal proceedings get along to be two co-workers in a JV in Guyana. Simon, thank you so much for joining us this morning. That is Simon Casey of our Bloomberg Oil and Gas team. And tune into our interview. Mike Wirth, Chevron CEO, will join Sonali and I in the next hour. But first, back to one of our top stories. Federal Reserve Governor Christopher Waller says he is starting to see cracks in the U.S. economy. He spoke to Michael McKee, Bloomberg's international economics and policy correspondent, in the last hour.
The private sector is not doing as well as everybody thinks it is. Like half of the employment growth we saw last month was in the public sector, and that means the private sector is not doing particularly well. So I was just joking that, if you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice.
The Fed's Waller speaking to Michael McKee, and I'm pleased to say that Mike joins us now. Mike, this is off the back of a Waller who last night also said he was ready for a 25 basis point cut. What was your takeaway?
Well, I think he is firmly committed to a 25% cut now. He wants to get ahead of any potential problems for the economy, and he sees more problems than perhaps some of the others do. He suggested that we could see the labor market freeze up rather rapidly, and it's better the Fed get ahead of that. Now, we all have to put this in the context of him being mentioned as a potential successor to Fed Chairman Jay Powell. I asked him if he would dissent, which would be maybe seen as a sign to Trump that he is on board if the rest of the committee is not. But he parried that and said he's made his views very clear, and he's not going to pre-commit to one thing or another.
He also spoke to you a little bit about the potential for the Fed chair position. He said he hasn't really spoken to the president about it. Of course, he's been very much in the news around this position. How do you see the race playing out and where he falls into the bigger picture?
Well, it's interesting that Chris Waller is saying he has not heard from the White House because, as you mentioned, he is on everybody's short list for Fed chair. And we have heard from Scott Bessent, the Treasury Secretary, that they have begun the process. Now, what does that mean? We don't know. How far have they gotten? Have they done interviews? We know that the president has spoken with Kevin Warsh often, and we know the president has spoken with Kevin Hassett and Scott Bessent on a regular basis because they are in the administration. So Waller's kind of the odd man out, which he acknowledged today. He said, I'm the outsider, but he did say if he was asked to become Fed chair, he would accept the position.
Mike, we appreciate you so very much. That is Bloomberg's Michael McKee off of a very busy week of Fed talk, both in terms of who might take a future position as well as the economic data that could or could not suggest a rate cut early this year. Now, some more movers on our radar. We're watching American Express outperforming expectations in the second quarter as affluent clients continue to spend. It's not enough to please the market pre-market. Amex still down about 0.4%. But of course, we know that a lot of people are watching this K-shaped recovery. However, Danny Schwab, I think Schwab and Interactive Brokers are quite interesting. Robinhood reports next week. Both of those stocks up as Schwab beating earnings estimates. Client assets hit a new record.
Yeah, and you have seen retail investors flock to stocks. They keep buying the dip. And it is that volatility, to your point, Sonali, of the Schwab and IBKR being connected. It's also that volatility that allowed Interactive Brokers also to beat net estimates, too.
Absolutely. And then, Denny, it's really interesting. You see that the retail trade is something investors are watching more and more of. You're seeing a lot of others also flock to the crypto world to see where those retail investors are going, and that has been getting a big boost in the market. Well,
Scott Rubner, who was previously at Goldman Sachs, now over at Citadel, wrote this really interesting note saying that the breadth of demand coming from retail looks like 2021. It looks like the pandemic. So are we back in that environment, especially as crypto picks up again, too?
And Citadel Securities, of all places, will know because they handle so much of that retail volume, Danny.
Very true. All right, coming up, we're going to talk more about Netflix analyst John Blackledge of TD Cowen. Next, as it kicks off the big tech earnings season, Netflix down 2.6%. This is Bloomberg Open Interest.
And now to high interest, a look at what's making headlines around the world. 3M beat profit estimates and raised its forecast as it makes strides in its turnaround plan under CEO William Brown, who joined the company last year. 3M has put measures in place to mitigate tariffs, including shifting production. And Union Pacific is exploring an acquisition of Norfolk Southern in what would be the largest railroad deal ever. The combined company would have a market value of nearly $200 billion. Analysts are positive about a possible deal, but warn that any transaction would face significant hurdles. Norfolk Southern still up almost 3.6% pre-market nonetheless. And Meta has hired a pair of key artificial intelligence researchers who worked at Apple, and this is shortly after poaching from their former boss from the iPhone maker. The hires are part of a scramble for AI talent across the technology industry, with Meta being especially aggressive in its recruiting, Danny.
I was going to say, this feels like a daily occurrence now that Meta poaches some person for X company. So I'm sure we'll hear more of that.
Stories we've seen before.
It's exactly spending so much money. And look, it is going to be Meta we're hearing from next week or later when it comes to their earnings. We already heard from one tech giant. It is Netflix. It beat expectations in every major metric, raised its forecasts. Shares, though, down 2.6%, I should say, in the pre-market trade. Joining us now, I'm pleased to say, is John Blackledge, TD Cowen Senior Equity Research Analyst. He has a buy rating on Netflix with a $1,450 price target. Great to see you this morning, John. So after a nearly 43% run-up in shares so far this year, was the bar just too high for Netflix?
Yeah, and it's almost doubled over the last year. And as you guys said, we got a great second quarter revenue accelerated. They beat on op income. The 3Q guide was ahead of consensus. They raised fiscal 25 revenue, operating income, and free cash flow guide. And we raised our numbers slightly, and our price target went to $14.50. But and shares were up 2% yesterday. I think they probably, and I think investors got what they were looking for. They were definitely looking for a raise to fiscal 25 guide, but I think it would have had it been Herculean for it to be up significantly off the print, just given the run as you just mentioned.
But being up is one thing, being down is another. It's still down about 2.7%. I mean, to the extent that this company could have given investors a little more to hold on to, what would that have been?
Yeah, I mean, well, they raised revenue guide $1 billion at the midpoint. They raised the margin guide to 30%. I mean, I think some people were kind of picking at engagement. They're publishing this engagement report. It was up 1% year over year. The market share has been kind of flat in the U.S. And the company's like, basically like, hey, we've increased our spend on content 50% since 2020. We're focused on scripted and unscripted, episodic and feature film content, and obviously growing out, kind of their live event business. And they think that their engagement will go up. And I heard you guys talking about it before. They obviously have a massive second half slate. So they think engagement will go up in the back half and in coming years based on their various investments in content.
Well, you just hinted at this, John. Netflix said yesterday that its addition of U.S. viewers, of U.S. customers, it hasn't grown. It's about the same it has been over the past couple years. Is this just an oversaturated, stagnant market, or is some of what you're talking about, a big slate coming up, enough to reinvigorate the American market?
Well, they actually said that they don't give member metric anymore, right? They stopped giving that this year. But they did say that their member net adds grew more than their internal expectations in 2Q, and it was late in the quarter. And the interesting thing about it is, what did they launch kind of late in the quarter? They launched Squid Game Season 3, and they also launched other good content in June. And so I think that had an impact on the member growth in 2Q. And they told us, management told us in our callback that members grew across all 4 markets. Most of the growth was outside of the U.S. because the U.S. is the most penetrated from a broadband household penetration perspective. But I think what's interesting about the strong member growth in 2Q as it relates to the back half of the year is they do have Wednesday returning in the third quarter. They do have finale of Stranger Things in the fourth quarter. And I think those things will help drive members, both retention and member growth in the back half of the year. And that will be helpful for them and momentum, going into 2026.
I'm wondering, John, if there's anything to extrapolate by how investors have been treating Netflix's earnings. For example, if you pull up the Magnificent Seven, which Netflix is not one of, right, you do see only significant price appreciation in about half of that index. And does this mean that even if a Netflix can show pretty solid results and see a little bit of a dip post-market, does that mean the rest of the Mag 7 are far more vulnerable?
I don't think so, and I don't cover all of the Mag 7, but I do cover Amazon, Meta, and Alphabet. I think it's specific to the companies. Just for instance, we have Meta, Amazon, Alphabet beating sell-side consensus revenue and operating income, but specifically for an Amazon, just very quickly, we're looking for AWS revenue growth to accelerate. That's a big thing for Amazon and accelerate in the back half of the year. For Google, Alphabet, looking for Google search growth to be strong, and also the cloud business to be strong. So there's different things for each company. Meta, the ad business should be good, but as you guys mentioned, their release of Llama 4 was disappointing, and now CEO Zuckerberg's in this AI talent grab. They did that big investment in Scale AI. So it'd be very interesting how they talk about their AI ambitions, as all 3 companies actually are, as you guys know, are investing significantly, historic spend in AI infrastructure.
Yes, it is capital expenditures that are quite literally lifting up the entire market with the sheer number of dollars being spent. So, John, we'll get those Meta results not next week, but the week after. At what point do we start to think again about this idea of the year of efficiency? It feels like so long ago for Meta, but at what point do investors stop rewarding the AI push and the spend going on to it and start thinking again about this idea of efficiency?
Yeah, I mean, They're growing headcount. Their cost growth is accelerating a bit this year, and obviously, a lot of people are talking about these huge pay packages for the recent AI talent grab that the company is doing. But I think investors expect them to beat with their core ad business. That growth is strong. AI is helping drive, kind of content recommendations, ad targeting recommendations, and CEO Zuckerberg is a great communicator and inspires confidence in investors. And they get the company and the shares get some benefit from his communication relative to maybe some of the other players in the space.
John, we thank you for joining us this morning. That is John Blackledge of TD Cowen, setting up to be a very interesting earnings season after Netflix's report. But we're going to talk about another darling in the space of technology. Traders keep piling into NVIDIA, but the rally is showing signs of overheating. We're going to take a look at the stock next. This is Bloomberg Open Interest. And want to get a check on futures ahead of the opening bell because we're looking at green on the screen. The S&P 500 more than 0.1% higher heading into that opening bell. The Nasdaq 100 pretty much flat. It's trying to break into the green as well. Let's see if that could hold. Of course, we have those Netflix earnings this morning that are sending that stock lower at the very least. But of course, earnings season is just really kicking off. Russell 2000 futures, though, are flying a little bit higher, about 0.5%. Keeping an eye on NVIDIA this morning, super interesting, up about 0.25%. It's interesting. A lot of analysts now a little worried that this is entering overbought territory. The stock is now worth, according to its market value, about $4.2 trillion. BTIG says the sentiment is getting borderline giddy. So, Danny, a lot of interest in this. Of course, this is what's leading the Magnificent Seven a little bit higher.
But maybe it's worth it, especially if you have a Jensen Huang who is now being able to shape White House policy that's being allowed yet again to sell H20 chips into China. You could look at it not exactly the same, but kind of like Elon Musk in the beginning of Trump's presidency. Maybe he has the president's ear, and therefore some of that valuation, extra valuation and premium might be worth it.
This is a strange earnings season because you have the political rhetoric also really seeping into the market. That's kind of overlaying how people feel about the numbers themselves. We heard from TSMC about some guidance. We heard from ASML. But we're ending the week pretty strong with all of that noise. And, Danny, we are less than 4 minutes away from the opening bell here. We are looking at an S&P 500 that's looking to break into the green and the week strong. We were at 6,300 earlier in the week, a new record high. Might have forgotten that in the middle of all the earnings and data. Stick with us. We're going to begin the trading day with Lori Heinel of State Street Investment Management. This is Bloomberg Open Interest. And we are moments away from the start of trading. This is Bloomberg Open Interest. I'm Sonali Basak. We are trying to keep in the green this week. We have the S&P 500 futures still riding higher, about 0.1% as we head into that market open. Nasdaq 100 also holding on, accelerating those gains heading into the open, about 0.2% higher. And there you have it, the bells. Let's take a look and see who is standing at the Nasdaq. We have FinWise Bank, and they are about to join they are joining the Russell 2000. They are celebrating that milestone, and of course that is an index that investors are watching very closely. And of course on this side we have New York City Emergency Management, Danny, ringing the opening bells at the New York Stock Exchange as investors try to end the week in the green.
Well, here's one stock that is decisively ending the week in the green, Sonali, and it is Chevron. It has won its arbitration battle with ExxonMobil and has closed its deal finally. $53 billion deal to buy Hess. It took 20 months. That's how long ago this takeover was announced, up 2.5%, 2.57% to be specific. They're going to have to work with Exxon now in Guyana. Really interesting how this moves forward. And Sonali, I'm pleased to say that the Chevron CEO, Mike Wirth, will be joining us in about half an hour's time.
Very much looking forward to that conversation. We're also keeping an eye here on Netflix. Results did beat expectations in every major metric. It raised its forecast. That was not enough, given that the stock has soared almost 50% from an April low. You're seeing Netflix shares down about 2.7% at the open. And speaking of valuations, Bank of America strategist Michael Hartnett is warning that a bubble is brewing in U.S. stocks. In his latest note, he writes that the clearest sign would be if the market ignored an increase in inflation expectations and bond yields hitting new highs. That all is as we await the latest UMISH sentiment data in less than an hour. Joining us now, Lori Heinel, Global Chief Investment Officer at State Street Investment Management. What do you feel about where we are in valuations for the U.S. stock market, particularly the S&P 500, relative to where you see fixed income trading right now and any upside risk to the bond market?
Well, right now, we think that valuations, while they're extended, they're somewhat warranted given what we're seeing in terms of earnings growth. And we don't forecast yields to go much higher from where they are right now. Actually, if anything, we see short rates coming down, which will give room for a bit of a rally in bonds towards the back end of the year. So right now, we're in a bit of that sweet spot where valuations, while a little stretched on a relative basis compared to other parts of the world, look pretty attractive.
How much confidence do you have so far in this earnings season? What we've heard, Lori, from the airlines saying that more customers are going to be buying tickets to the banks with a really strong showing. Is this full steam ahead a very resilient U.S.?
Well, I'd hardly call it full steam ahead, but certainly a lot of the risks have really passed. I mean, that crisis moment in trade has passed. That's given a little buoyancy to consumer confidence. Labor markets are still pretty strong. Earnings growth is coming in pretty good. And it seems as though between the balance of how tariffs are evolving and how companies and consumers are navigating that, we're kind of getting behind what we saw in the March-April period. So we actually upgraded our forecast for the U.S., and we actually think we're accelerating it to 2026.
How do you feel about earnings season so far and what it could mean for any upside potential for the broader index? Do you feel that it's what's been working well that will keep working well, or do you see any undervalued opportunities to push these indexes higher?
Well, there are a couple of things. First and foremost, it is still going to be very idiosyncratic. So we're starting to see some of the areas like you described, whether it's IT or some of the consumer discretionary or some of the other areas doing pretty well in here. And importantly, some of the top line forecasts being upgraded, which is even a better sign in many respects. That doesn't mean we're out of the woods completely. Certainly, we still have a lot of specificity that has to come out of the tariff negotiations. And then finally, the other positive here is that we finally did get some fiscal certainty, if you will, with the one big beautiful bill passing. So there again, the momentum seems to be to favor U.S. stocks right now.
And you also still like short duration, Laura. You say they retain their appeal. How do you understand what is priced in this bond market? From understanding where the Fed goes to the intrigue over what happens to Powell's future and who the next Fed chair might be, what exactly is in the price?
Well, a lot of it still is fundamentals, right? So we believe that the U.S. economy is looking pretty good. We're downgrading our risks of a recession. But we also think that there is going to be a need for some policy stimulus towards the back end of the year to perpetuate that. So we are still forecasting some moves by the Fed later this year. And so that to us believes that it leads us to take more of a short duration position, but also be constructive in terms of not having a lot of backup in yields from here.
Now, as we talk about the potential for where interest rates are going through the remainder of this year and certainly into next year, I do want to point out just a little bit from our interview with the Fed's Chris Waller as well. Let's take a quick listen.
Whatever they choose, you're going to have somebody that has credibility with the markets, or you will see, as Jonathan was just talking about, you're going to see inflation expectations spike. You will not get lower interest rates. You will get higher interest rates. This is well known. We've seen this everywhere around the world when this happens. And I know Scott Besson knows this. So this is not something that is lost on anybody.
Now, I want to point out here that you're looking at a 10-year yield that since the end of the prior month, we're 20 basis points or so higher. And you do have Christopher Waller recognizing that without any certainty around the Federal Reserve's future composition, for example, you could have that upward pressure and inflation risk under the surface. And of course, Christopher Waller is one of the people that has been long rumored to be in the running here now for a future Fed position as chair. Now, how much risk is there from now until May of next year when the Fed chair does step down in terms of who the president chooses, what the strategy is in between, and all of his allies pushing for change in the Federal Reserve's course?
Well, we try to focus on the fundamentals, right? What's the growth of the economy? What are the inflation risks? And we actually think that inflation will remain relatively under control. We try not to worry about the politicization, if you will. If you think about the role that the Fed has here, it is a very judgment-based role. I mean, they have to look at, where inflation is. They have to look at where, employment is. And if anything, they've sort of faded towards focusing on that employment picture as one of the big markers for how they're going to pursue policy going forward. So we still think that the Fed is likely to cut before the year is over. In fact, we've got penciled in as many as 3 cuts. So we think that will be constructive for elongating this recovery.
Lori, can you continue to ignore the politics, especially if we get one of the Kevins in? I believe it was Kevin Warsh who said there needs to be a regime shift at the Fed. If it is one of them at the chairmanship, does that need to change for you?
Well, a lot of what gets said as you're talking through what might happen does not necessarily manifest in what actually happens when various parties get seated. So we're going to wait and see how, one, the economy unfolds, how employment picture and inflation dynamics unfold, and then we'll watch and see, as some of these other things play through.
I want to talk also about a part of the market here that's been a little underloved. And if you are still seeing the market pricing in at least one rate cut this year, if not 2, then the Russell 2000 you would expect to be performing just a little bit better. This did get a bid in the center part of the year so far, if you will, but it's still only up less than 2%, about 1.6% on the year. Do you believe that rate cuts can provide the boost to this index that investors have been waiting for?
Well, more importantly, again, the economic backdrop improving is the number one thing that will boost that market. And we've actually recently upgraded our allocation to small cap stocks on the back of that improving economic trajectory. Rate cuts would be an additional buzz, if you will, but it's not necessary. We don't think that rates are necessarily restrictive right now relative to the underlying economic strength. So while we do forecast cuts, we'd like to see cuts. We don't think that's necessary to let small caps unleash a little bit of power here.
Laura, I mentioned this to Sonali earlier in the program. Scott Rubner, who's now with Citadel Securities, pointed out that retail share of trading volume has gotten back above 20%. That was the kind of levels you saw immediately after the pandemic and in the 2021 meme kind of craze. It's these sorts of things that people point to, saying things maybe look a little bubbly, maybe a little bit of frothy. Does that concern you at all? At what point do you say, I know you said at the start you're not worried about valuations. What do you look for maybe to start getting concerned again?
Well, a couple of things that we would look for to start getting concerned again is that suddenly the employment picture deteriorates massively. And we have seen some recent high-profile examples of companies that are announcing layoffs and things like that. So the employment picture is one that we are watching probably the most closely because that will feed into consumer sentiment and into consumer health. The other thing that we are going to keep watching, though, is that inflation picture, because again, if you start to see inflation get out of control, whether it's because there's robust underlying growth or because something else happens, that would be something else that would be destabilizing and would probably put upward pressure on rates. So we still focus on the fundamentals.
Lori, we thank you so much for joining us. Happy Friday to you. It's the end of a long week, and again, next week is another busy one as we continue into earnings season. That is Lori Heinel of State Street Investment Management. Let's get a check on the stock market right now because we are looking at some green on the screen to end the week in a solid territory, almost 0.2% higher. And when we take a look at the movers here, it's very interesting to see your actual biggest decliner on a points basis is Netflix. So they've given investors largely what they want, but they are still down. Now it looks like about 4.6% into the market open. So pretty fascinating there. This is a market trading on valuation. On the flip side, you have Tesla as the largest points mover on the upside, followed by Amazon and Nvidia. So big tech performing in a very mixed way today. I would also point out American Express is down 2.6% after the market open. Remember, they also impressed on a lot of levels, but not quite enough. I want to flip up the board here, also look at sectors and see what we're taking a look at. Yields are lower on the day, yet you do have that providing a boost. Financials up a little more on the day. Consumer discretionary, we were talking about Tesla up on the day, but utilities, here you have it, your biggest gainer. It's almost 1% higher to help that index. But you could see broadly, Danny, we're looking at broad-based gains in the S&P 500 to end the week. So a very healthy trade, even if you do have a mixed set of outcomes from this earnings season in terms of an investor reaction.
Very true. Mag 7 as a whole, though, is still gaining today. Sonali, should that stick, it will be its 9th consecutive day of gains, the longest winning streak since November of 2020. But as you pointed out, Netflix, it isn't there in the Mag 7, maybe for the best today. Netflix fortifying its image as a streaming leader as it reports a strong quarter. Coming up, we're going to break down the details for you. You're watching Bloomberg Open Interest. You are watching Bloomberg Open Interest, another record for you. How about that as a way to end your week? Not huge gains here, up about 1/10 for both the S&P and NASDAQ. Russell, that outperforms up about 0.5%. Ninth consecutive day of gains for the Mag 7, the longest winning streak since November of 2023. But let's look at some of the top calls this morning, some of the analyst action that is in focus. First up, Chipotle, that gets an upgrade to a buy at BMO Capital. The analyst says it's well positioned for growth in the second half of the year, those shares up 0.5%. Next up, Abbott Laboratories, also getting an upgrade for them. It's from Jefferies. The analyst saying the recent pullback is too punitive, and the analyst likes the company's fundamentals, up less than 3%. Finally, Wall Street weighs in on Netflix after it beat expectations, raised its full-year forecast, though falling 4%, pretty chunky this morning. Piper Sandler, Morgan Stanley, and Wells Fargo are among the banks raising their price target. Morgan Stanley says the company's use of AI reinforces its bullish view. And for more on Netflix, pleased to say that we are now joined by Geetha Raghunathan, media analyst for Bloomberg Intelligence. Geetha, great to see you this morning. For you, which side do you lean on? The sell side there saying, hey, it was a great quarter, or what we're seeing over here, shares falling 4% this morning?
Yeah, thanks so much, Danny. So it was definitely a solid print. I mean, everything that we had hoped for, I think Netflix delivered. I think what we're really seeing this morning in terms of the muted reaction in shares is, expectations were very, very elevated coming into the quarter. And while the company did raise guidance, both in terms of revenue and in terms of its operating margin metrics, some may argue that the source of that raise was somewhat of a low quality source, which was more tending towards FX, currency headwinds rather than, fundamentals. But still, fundamentals extremely strong, Danny.
So what does this mean in terms of the right valuation for Netflix? To the extent that you see investors kind of getting jittery about how much it has run up, what would it be doing that would justify that valuation to be much higher in the next year?
I mean, it's doing everything right, Sonali, as of right now. Yes, some investors may argue that at nearly 50 times forward PE multiple, this is, a very rich valuation. But I think if you kind of just look at the trajectory of the fundamentals, and if you look at all of the catalysts that are upcoming, so we had pretty strong performance in the first half, but really what we should be focusing on for Netflix is the second half. And it's going to be an absolutely monster second half because they have some of their biggest titles. It's standout content for them, some of the biggest titles that they've ever had in their history. So you have a great combination of returning hits, whether it's, Stranger Things or Wednesday, you have the NFL, you have other live events like boxing matches, you have movies, so everything and more that you could hope for. So that obviously is going to drive a lot of subscriber momentum. And then the big catalyst that should play out through 2025 and definitely in a big way in 2026 is the ramp up of the advertising business. And that definitely will help. So really the metric that we're looking for Netflix in terms of operating metrics is, revenue growth, right? And we saw an acceleration of that revenue growth, and whether they're going to be able to deliver, those 13 to 15% revenue gains. And I think they absolutely will. And then, of course, the operating margin increase. They took it up to about 30%. I think they can go very, very much higher. I think it's a pretty conservative outlook, just kind of looking at, what they've achieved so far. So it looks like they're keeping some dry powder almost for the fourth quarter, just kind of based on their results for the first half as well as for the third quarter guidance. But again, it's a little bit of wait and watch. But I think valuation definitely will be supported just by the strength of their fundamentals. And then you look at free cash flow. Next year, we're looking at something like this year, we're looking at about $8.5–9 billion in free cash flow. Next year, $13 billion. And they're deploying a lot of that towards buybacks. So I think, again, that really provides some valuation support there, Sonali, to answer your question.
Also, what you're underscoring, Geetha, is Netflix just standing on a level of its own. The other streamers unable to catch up, except, Geetha, YouTube. YouTube really starting to encroach on its territory, especially when it comes to things like children's programming. How do you see the competitive landscape evolving between these two?
Yeah, you're absolutely right. I think you're right that Netflix has won the content streaming wars, but with YouTube, yes, there is an engagement issue here because Netflix kind of comes in terms of share of viewing at about 8 to 9%. YouTube actually leads it with about 13%. But this question did come up yesterday during the call as well, and I think the way that management answered it was, they're both focused on different parts of the market, right? So Netflix really more focusing on premium content, on scripted content, on movies. YouTube really going more after user-generated content. I think with the use of AI, we are going to see, AI for content creation kind of level the playing field a little bit more. But the way that, the Netflix CEO, Ted Sarandos, kind of framed his response was, both Netflix and YouTube together only really account for 20% of all viewing. So really what Netflix is focusing on right now is going after the remaining 80%. And I think they have a huge opportunity there.
Geetha Raghunathan of Bloomberg Intelligence, we thank you for following all things Netflix for us. A lot of eyes on that trade this morning. But coming up, we're talking about another part of the investment universe that has been attracting a lot of interest this week. It's been Crypto Week in Congress, and crypto tops $4 trillion after Congress finally passed sweeping regulation for the sector. More on that next in your ETF Friday update. This is Bloomberg Open Interest. This is Bloomberg Open Interest. Let's get a quick check on stocks here. We're looking at an S&P 500 looking to end the week in green territory. It's up about 0.1%. The NASDAQ 100 also up around the same amount, though you do have volatility nice and low. The dollar nice and low, too, is set up for a proper trade today. Danny, you're also looking at some individual movers that are kind of interesting. You're looking at Apple trying to turn around losses on the day and head back into green territory, though Meta still lower on the day. I know that's not dragging down the Mag 7 totally today, nor is Netflix because it's not included, but you are seeing Netflix down today too. We're talking about Tesla today as well, up around 2.6%. This has been throughout the morning generally your biggest points contributor to that NASDAQ 100, but those gains are broad-based. We're keeping an eye on crypto, stablecoin related stocks as well. Coinbase flying up more than 6%, Circle up more than 2.5%. Of course, it is Crypto Week in Washington and legislation just flying through Congress.
On that point, Sonali, now crypto assets as a whole, they have surged past $4 trillion for the first time. It is what you mentioned. It is the House passing the stablecoin legislation yesterday. Bitcoin, though, it is falling. That's down about 0.5% as those other stocks gain. For more, let's bring in Athanasios Saravegas, ETF analyst at Bloomberg Intelligence. Athanasios, great to see you this morning. Just how big of a boon is this to the industry?
Oh, hey, Danny, good morning. Not as if crypto ETFs needed any more tailwinds because they've already done really well. This is a massive boom, and it's because you just mentioned Bitcoin is down, but things like Ethereum are up, some of the other altcoins. So this is definitely a boost, probably more so even for the altcoins, just because they're now going to be sort of legitimized. This is only just going to open up the product pipeline for more ETFs. It was, if anyone has been following, it was obviously a long road to get Bitcoin approved, Ethereum. That's where it stopped. This is now going to just open up the door for all these other filings. So, it's not really hard to see that this is obviously going to be a really, really big boost to ETFs, product development flows. We're already seeing Ethereum had record flows this week leading up to this passage. So it's definitely caught the eye of all these ETF investors.
How do the new rules around crypto change the thinking around Ethereum? Because your colleague, James Seyfarth, and I've got to say, I get off the show and I go listen to him on Twitter sometimes to hear about how these rules are changing. A lot of audio on that platform with him these days. How are the rules changing enough to justify interest around the staking ETFs that are being filed?
Yeah, obviously they're not as comfortable. They weren't as comfortable with it before this passing, but it seems like this is going to now, there's been some filings, some other issuers have filed for staking, which always kind of baffled me because staking exists in other regions like in Europe. So this is definitely going to open up the door for more staking. A couple of the issuers have already sort of, jumped that gun with some of the new filings, but I get big boosts for Ethereum and again, some of the other altcoins as well.
Athanasios, we thank you so very much for joining us today. That is Athanasios Serafagis of Bloomberg Intelligence. And tune in to ETF IQ on Mondays at 12 p.m. New York time. A little bit of crypto and a lot on the broader indexes as well. Speaking of checking on stocks here, of course, we've been talking about it. Ending the week in the green despite all that headline risk we started with. We are back above 6,300. It is that moment that we have been waiting for. And some of the stocks in the green include Chevron. We're going to be speaking to Chevron Chairman and CEO Mike Wirth next. Stick with us. This is Bloomberg Open Interest. And we are 30 minutes into the trading day. We're looking at markets ending the week in a green territory. And more than that, Danny, we are ending it above 6,300. It looks like we're on track to go there. The 10-year yield, we are 20 basis points higher than where we ended last month. However, we are looking at yields closely today. We have a little more economic data waiting to hit at the top of the hour. Welcome back to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Danny Berger. Matt Miller and Katie Greifeld are off. And yeah, Sonali, it has to be yields that are probably helping to support equity, especially small caps. Front end down more than 4%. And Sonali, we have some breaking news when it comes to the UMich survey. Sentiment rising again, 61.8.
We are coming in above estimates, and this has been a week, Danny, where data has come in strong. We will get into this data more now with Bloomberg's international economics and policy correspondent Michael McKee joining us. And the softer data, the consumer data, has been kind of disputed all year long, but at the same time, we are seeing it kind of hold up, aren't we, Mike, with the rest of the week in terms of positive news about the economy?
Positive news about the economy. We saw that with retail sales being a bit better than expected. And now you've got consumer confidence rising for a third month in a row. The sentiment number, as you mentioned, Danny, 61.8, up from 60.7. Current conditions are seen much better, 66.8 from 64.8, and a slight rise in expectations for the future, 58.6. from 58.1. The Fed will be cheered, and Chris Waller will be cheered by the expectations for inflation. 4.4% is the one-year expectation. That's down a lot. 5% was the view last month, and 5 to 10-year inflation at 3.6, down from 4.0. What is probably going on here is that the president has threatened a lot of things that haven't happened yet. So people aren't seeing as much damage to the economy and to their own pocketbooks from tariffs and everything else as they might have expected when we saw consumer confidence plunging. So we'll have to wait and see once the tariffs actually do go into effect, a majority of them, whether this rise in confidence can hold.
Mike, you say Waller will be pleased, but I was listening to your conversation with the Fed governor, and here's some of the notes I took. He called this particular piece of data the Michigan thing. He also said he always looks at market-based measures and not necessarily ones of survey. How much does it even matter to the Fed anymore?
It doesn't matter all that much, but the inflation expectation numbers do. Waller made the point that if things start to go south in the economy, or if the Fed is not seen as having credibility because of Trump's attacks, then inflation expectations would go up, and that would be his problem.
I also want to point out the fact here that without the stock price appreciation that you've seen to portfolios, you do have the University of Michigan really saying here that without that, you actually see a little bit of a retreat here in sentiment for some participants. How much does the stock market matter in terms of how people feel?
It does matter in terms of feelings. It's a soft indicator, but people look at the Dow Jones and the S&P, and they see it sort of as a measure of the economy. And economists would tell you it's not, of course, but it's the proxy that a lot of people use on a day-to-day basis to figure out maybe where the economy is.
In less than 30 seconds here, Mike, oil prices as well. We've seen a significant retreat in the course of the last couple of months also. How much is that providing some juice to how the consumers are doing right now?
It provides a little bit, but basically, Sonali, the rule of thumb is we have to exceed the previous high or fall below the previous low for people to really react all that much. They get baked in their head of what gas prices are. And if you go up 10 cents, go down 10 cents, it doesn't really make a whole lot of difference to their thinking.
Mike, we thank you so much for your time. Of course, that is Bloomberg's Michael McKee on the heels of the latest economic data. And we welcome now our Bloomberg television and radio listeners. Of course, we've heard this morning that Chevron has closed on its $53 billion deal to buy Hess. And that is 20 months after the takeover was first announced. We are now joined by Mike Wirth, Chevron chairman and CEO. And you must be so relieved. This has been a long path to getting here. Your stock has really felt that time pressure as well. How do you feel now that the deal is done and what it could mean for shareholders moving forward?
Well, we're pleased with the decision that came out of the arbitration panel this morning. We're also pleased with the decision that came out of the FTC yesterday regarding John Hess's eligibility to serve on Chevron's board. And this really helps create a premier international oil and gas company. We are one of the largest producers in the world. We've got the highest cash margin in our upstream business of anybody. We're one of the largest producers of both oil and gas in the United States, largest leaseholder in the deepwater Gulf of America, and have industry-leading free cash flow over not just the next couple of years, but out into the next decade now as we combine with Hess. So it's good for us. It's also good for our industry because this was a transaction that kind of, as you say, impacted, I think, our investors, the uncertainty, and it hung over the industry a bit because the question about what would it mean for potential future transactions is one that people were paying close attention to. And so I think having that resolved and affirming the industry practice that asset level rights of first refusal don't apply in a corporate level M&A transaction is one that's going to be very important for our industry.
I mean, Mike, one of the other reasons this industry couldn't keep its eyes off this case is because you had two giants, you and Exxon, really battling this out. But it doesn't end there. Sonali and I have been discussing it this morning. Now you have to work with Exxon. You have a JV in Guyana after this. How is that relationship going to be moving forward after this case?
Well, we work with people all around the world. Our industry is built on partnership because the scale of our investments usually requires partners to help share risk. We also pool technical resources in order to develop some of these challenging opportunities. And so partnering is very familiar to us. It's a core value. We put great pride in our ability to be a good partner around the world. We work with Exxon and other places around the world and have for many years. In Guyana in particular, most of the people that will be involved in this are going to be legacy Hess employees who've got years and years of history working together with CNOOC and Exxon on this project. There are good working relationships at that level, and all three companies have worked together to create the incredible value that is seen in Guyana and the prospects for the future. So I expect that those relationships will continue to be good.
But up till this point, there was a little bit of acrimony here in the pursuit of Hess when it comes to Guyana. When was the last time you talked to Darren Woods? And what can you tell us about the relationship that both of you are building in results of this JV?
Well, we see each other at industry functions and the like, and so we speak from time to time. But this has been a sharp difference of opinion. We believe that a plain reading of this contract, which is a confidential document, was very clearly, as I described earlier, that a right of first refusal would exist if there were a transaction at the asset level, but not at the corporate level. The arbitration panel has affirmed that interpretation, and so we'll move forward from here. But look, it didn't have to take this long. I wish it would have gone differently. We tried early on to find a way to resolve this and thought we were working together in good faith, and then abruptly were notified that the other parties had decided they wanted to resolve this through arbitration. At that point, we believed we had the right side of this argument. We had to stand up for that, and that's taken some time.
Well, you mentioned the other win you had very recently was the FTC allowing you to put Hess onto the board. Is this a much more easier regulatory environment for you to be operating in right now?
Well, it's certainly been a change in the mood and I think in the policy that we've seen with the Trump administration. This is an administration that wants to use energy as a competitive advantage for our economy, which it is. Our country is blessed with an abundance of energy resources of all types, and it's not just oil and gas. It's solar, it's wind, it's coal, and you can go on. The agricultural resources that contribute to renewable fuels. And this is an administration that wants to use those for the benefit of the American economy, for the benefit of the American consumer, and that's proud of the American energy industry. And I think that's a welcome change for our economy. It's certainly a welcome change for those of us that operate in this industry and are committed to the U.S. And so I think it's very, very positive.
You mentioned a little earlier that it removes a lot of uncertainty when it comes to mergers and acquisitions. How do you think that this will change the competitive positioning of the industry through the remainder of the year into next year as many of your rivals, your partners, reconsider what their footprint should look like?
That's hard to predict. That's kind of a hypothetical. I can't really speak on behalf of others. But I do think that the clarity that contracts that are written to govern these ventures that we go into are ones that will not be used to peel assets out of a corporate level transaction is an important signal for our industry. We have companies that come into this industry, people who take risk and build companies from nothing. They grow them. Oftentimes the way that they get rewarded for that is by selling that company. And so it's the nature of our industry that transactions are part and parcel of how it functions, and something that might change the historic practice creates some uncertainty. And so I think with that uncertainty resolved here, you do have more confidence for people going forward.
This is also coming as you've been undertaking some restructuring efforts too. So with this deal under the belt, do you look at your oil and gas portfolio and say this is sorted now, or are there other areas that you're still looking to add on to?
Well, you're always looking to improve your asset base, and it's a depletion business. Every day we produce, and those barrels can't be produced again, and so you have to replace them over time. It's also a business that's very capital intensive, and so you need to be efficient. Margins are thin. Prices over time, really, if you look at it and inflation adjust, prices haven't changed much for decades. There's volatility along the way, but the industry uses technology and efficiency to continue to keep the cost of energy very affordable as an input to the economy. Those things haven't changed, and I think all of us in this industry continually look for ways to improve the productivity of our assets and the efficiency of our operations.
So speaking of affordability, it's interesting because on one hand, when you have oil prices below, this is WTI, below $70, last year around this time we were above 80. How does that change the calculus for how you want to address the industry? Remember, in the onset of the Trump administration, this was a market perception that drill, baby, drill would be the three words that define this year. But that's hard to see with this type of suppression of oil prices.
Well, we respond to market signals, and our company lays out a program. We invest for the long term based on a long-term view of prices. What prices do in any short period of time can influence the cash flow of the company and the short-term financial results, but they don't have a material impact on our longer-term plans because we develop assets over a period of years and often decades, and their lifespans are oftentimes many decades. So we take a long-term view on supply, demand, technology, competition, and price to set our capital spending plans. And they really don't, absent an event like COVID, where you see a dramatic contraction and a lot of uncertainty, we tend not to move our investment plans around over shorter-term movements in commodity prices.
Mike? Weeks away from earnings season, and on the heels of a deal finally closing, Mike Wirth, chairman and CEO of Chevron, really a new day for the oil industry here. We'll be keeping an eye on how it plays out. Let's get a look at some of the stocks moving this hour as well, because people, in addition to big oil, have their eyes on big tech. Netflix reporting second quarter results exceeding investor expectations in every major metric, yet the stock's still down more than 5%, Danny.
It is down more than 5% after a 43% runoff. I know this one you're paying attention to, Sonali. Amex also down 3.5%, even though it outperformed expectations. Maybe this is kind of the same problem, just a big run-up. And how expensive is their card going to be?
Yes, I am totally watching that very closely. You have Citigroup trying to enter the space in a bigger way, MasterCard trying to come out with new perks, and of course, JP Morgan fighting pretty hard in that regard. So competitive space for the most affluent clients in the country. But beyond the affluent clients, you have more affluent retail traders, I suppose, don't you? You have Charles Schwab saying client assets are hitting a new record and trading revenue rose, brokerage topped earnings estimates. This is a Wall Street that is watching that retail trader who has been right by betting on some of the high-flying names and winning off of it.
Feels like 2021 again. Retail is buying. They're seeing the wealth of that. And now they're getting a boost from crypto, too. Coming up, Sonali and I are going to talk about just that, crypto getting a boost from Congress. We're going to be speaking to Bo Hines, Executive Director of the President's Council of Advisors for Digital Assets. That's coming up next on Bloomberg Open Interest.
Now, Congress is delivering a watershed victory for the crypto industry, passing the first federal legislation to regulate stablecoins and clearing the way for broader use of the technology in everyday finance. Crypto-linked stocks are getting a boost on that news. We'll be keeping an eye on them. But first, we're going to go to Washington. We're going to talk to Bo Hines, Executive Director of the President's Council of Advisors for Digital Assets, joining us now. Now, one reason it's interesting to talk to you is not only, of course, your fluency of what's happening in the process of passing these bills and also getting both the industry view as well as the regulatory view in here, but you also are quite close to the industry as well. When you look at the way that the bill has passed through Congress and, of course, the Clarity Act upcoming as well, what do you think that the industry is still going to be pushing for through the remainder of this year?
Well, look, I'll start by saying the president made big promises on the campaign trail to this industry, and now we're well on our way in delivering on those. You know, he promised to be the Bitcoin superpower of the world. He promised to be the crypto capital of the world. I think this is a monumental step in affirming our position there. You know, the industry's been fighting hard, but under the Biden regime, it was really mostly just policy through prosecution. These folks were victims of overregulation and blue tape that we had to cut down. And when we started, you know, devising a plan of how we would solve this problem, we kind of looked at it in 3 phases. We said we're going to have a demolition phase, getting rid of the overregulation. Then we're going to have a construction phase, which is underway. And obviously, we have one building that's been constructed here with stablecoin legislation. But we're heavily reliant on our colleagues up on the Hill to get this done. And then we have the implementation phase. So, you know, the president created the working group on digital assets that includes, you know, Treasury, Commerce, the SEC, CFTC, all the relevant actors inside of his administration. This has allowed us to have streamlined conversations, fix problems as they come up, and create an environment in which industry can thrive and build here in the United States. And so our message to players that have gone offshore is welcome home. This is the crypto capital of the world now. Under President Trump's leadership and our AI and crypto czar, David Sachs, this is the best place to be.
SEC Chair Paul Adkins, Bo, was also on Bloomberg TV earlier talking about this legislation, saying that they're looking at guidance and rules, in his word, to help people understand how to stay under trouble. What is your expectation and what is your hope that we see out of the SEC as it pertains to digital assets?
Well, look, the SEC has been phenomenal under President Trump for this industry. Whether it be rescissions or guidance they've been offering, they want people to come here and participate in the U.S. capital markets. You know, the crypto industry is thrilled about that, and you know they're continuing to do good work over there. We'll have Brian Quintes coming in as the CFTC chairman very shortly. I know that they will, you know, echo the same sentiment. So, you know, things are heading in the right direction. There's still work to be done, but I think that, look, we get stablecoin legislation signed into law today with the Genius Act. We move on to clarity with market structure, which basically just gives folks the rules of the road, who the regulator is, what the regulator's authority is. We get that on the president's desk in the fall, hopefully by October, and I think that's about 90% of what we need to do to ensure that we will be the crypto capital of the world. But, you know, it's an extremely exciting time. I think we have to thank really Senator Haggerty for pushing this so hard, Luke Pettit, his staffer, who's now over at Treasury, Chairman Hill on the House side, Speaker Johnson, Leader Thune. I mean, this is a monumental piece of legislation with the Genius Act. It updates archaic payment rails. It creates expeditious transactions that are more transparent, more cost-effective. This is great for the American consumer, and it's truly revolutionary. It's exciting.
I also want to get your view here on the president and his family's own crypto ambitions relative to what the industry wants to see. Now, how do you handle criticism. I know that you are advising the administration here on the crypto strategy moving forward, but the family has seen their wealth rise by hundreds of millions of dollars tied to crypto ventures that they're themselves involved in. How do you navigate that criticism between people who are in the industry and looking to build businesses and the money that's being attracted to the president's own view on crypto and ventures tied to crypto?
Well, look, the president's interest in this space is controlled by his sons under a blind trust. They have every right to participate in this space as any other American. These are private citizens. The reality is President Trump's a great business person, as are his sons. I would be shocked if they wouldn't be participating in this space as the great business people that they are. I mean, this is where the new technology for a financial system is emerging from. The president's obviously extremely supportive of that. He wants to update, an archaic system that hasn't changed for quite some time. And look at the ways in which, technology has changed in how we communicate, how we speak to one another. But the ways in which we move money hasn't. So the technology coming out of this space is instrumental for us to be leaders in the digital asset technological development race. And the president wants to support that, as does his family.
Well, Bo, it goes to this bigger question of this industry. It is growing very, very quickly, as you're hinting at. There are concerns about guardrails. For example, if they have to buy treasuries that back up the assets, what happens if one of these stable coins go under and there's a spiraling of selling that emerges across asset classes? What are the guardrails that are necessary for this industry as more adoptees come in?
Well, look, the Genius Act is very intelligently written in this way. You have to be one-to-one backed. You have to be audited. You have to ensure that you can prove that you have the reserves there, and they have to be U.S. Treasury notes. And this is great for the U.S. economy. It creates demand for our debt. It ensures U.S. dollar global dominance for decades to come. And that's why this piece of legislation is so revolutionary. I mean, this is incredible for the United States of America. And look, I mean, at the end of the day, one of the stablecoin issuers that's out there is going to be the fourth largest purchaser of U.S. Treasuries this year. That makes us way less reliant on folks like China, our competitors and the global economy. This is a fantastic opportunity for us to sell private business on buying our debt.
But Bo, to your point on stablecoins here, it is very significant to see how much they are beginning to hold in terms of U.S. Treasuries. There is an estimate by Apollo that this could rise into the trillions. And while that might provide some support to the Treasury market, there is a concern that China is using stablecoin, even U.S.-denominated stablecoins, to bypass SWIFT. Is the administration looking into that at all?
Well, look, with blockchain technology, there's complete transparency. And you have to, even state-sponsored actors, that would not be the smartest way in order to bypass systems to do nefarious things. And this is one thing we continue to echo as we educate folks on Capitol Hill and legislators who are concerned about, nefarious activity that's ongoing. At the end of the day, blockchain technology creates a system in which it gives the consumer the ability to control their funds, move them expeditiously, have instant settlement times, know that the party they're sending money to has received them, but it also gives us the ability to ensure there's not illicit activity happening on chain. And I think that this bill acts as the foundation for tokenization of public securities, which brings us into a completely new world in which everything will eventually be on chain. But look, it's an exciting time. We look forward to having this bill signed into law today, and we just can't thank the president enough for his leadership here.
Bo, you also have to wonder what happens from here on out. The Office of the Comptroller of Currency, for example, they're the ones who are going to be overseeing the new applications, but they've also lost a quarter, or are set to lose a quarter of their workforce with the recent cuts to the workforce in Washington, D.C. Are we set up to handle the load that's about to come? Is there a real concern there?
Absolutely. We have the necessary folks in these positions with jurisdictional authority that can absolutely manage this. Treasury will have a lot of input here, as will the SEC and CFTC. And look, we have this working group set up amongst all of the authorities that exist inside of the administration. We will be working together to streamline this process, make sure we have the proper oversight that's necessary to ensure everything flows smoothly.
Hey, Bo, we really appreciate your time this morning. I hope you get to go pop that champagne before the weekend begins. Bo Hines, Executive Director of the President's Council of Advisors for Digital Assets. And still ahead, we're going to be talking more about the economic impact of Crypto Week. Michael Faulkender, the Deputy Secretary of the Treasury, will be joining the Balance of Power today at 5 p.m. New York time. All right, it's a time to get a check on your stock market. We're seeing some of the gains start to peter out. We started the session really strong. Look at what we are now. We are now down, only 0.01%, but still we're not unable to hold on to the momentum despite some of the earnings expectations and enthusiasm. It really is Netflix that is dragging us down. Netflix shares, those are down nearly 5%. It is a high bar, but it's also a Mag 7 that's runned up tremendously, so you're starting to see that give back. When it comes to the sectors specifically, again, it was most of the sectors that were headed into the green. And you still are seeing that, but it looks like it's the comm sector. Again, it is all Netflix that seems to be dragging us lower. Some of the safety stocks, utilities up 1.9% this morning, but it is an S&P that's struggling to hit another record today, Sonali.
And coming up next, we're going to get more views from the C-suite. Stacked day today, Danny. Grocery aisle giants and smaller food businesses keeping a close eye on the trend away from artificial food dye. We're going to talk to the CEO of Unreal Snacks next. This is Bloomberg Open Interest.
The Healthier for You movement, it's making its way across the food and beverage industry. President Trump said this week that Coca-Cola agreed to use cane sugar in its products sold in the U.S., removing corn syrups. But one candy company has already been doing just that. Unreal Snacks has been making candy without artificial ingredients and unnecessary sugar for the past 15 years. Joining us now is Kevin McCarthy, the company's CEO. Kevin, great to speak with you this morning. And it's not just Coca-Cola. The International Dairy Foods Association said that they would stop using synthetic colors. RFK Jr. said between 35 and 40% of the food industry is now pledging to make the shift. You've been doing this for 15 years. Can you give us an idea of the costs and supply chain difficulties with making the switch that now these giants of the industry are going to have to start doing?
Absolutely. Well, thank you so much for having me on. I really appreciate it. And Unreal, we're a better for you indulgent snacking brand. As you said, it's been around for about 15 years, but we really are leading this movement within the chocolate snacking space and the chocolate candy space to really show that better for you and having amazing taste is an amazing combination, and that consumers are really craving that. And, I'll be the first to say that this is not an easy thing to do, but we're in this extraordinary time where, companies and brands are really embracing and realizing that consumers want better for you. They want cleaner ingredients. They want natural dyes. And they want products that taste truly unreal. And that's what we've been doing for so many years. And, we've been seeing just amazing growth in our business. We've doubled the business in the last 18 or so months, which is incredible. And that's really a result of all the work we've done, but also like the consumer momentum in this space is really extraordinary at this time.
Kevin, you mentioned this is hard to do. And I'm wondering if you can bring some details behind exactly how hard, how costly that could be, because do you see the likes of Skittles, M&Ms, the really big brand name types of candies that many people grew up with, do you see them caving and switching to do something that is more healthy and remove artificial dye and really meet the RFK Jr. push to do so? How much would it cost them?
Yeah, it's I think the first step in this is really embracing the consumer demand, how people are really demanding better for you and cleaner ingredients, and especially in artificial dyes. You've seen all these brands, big companies move away from them, and that's a great first step. But it is difficult to implement. It is difficult to learn how to use natural dyes, how to make them look really, really good, to make sure that consumers don't turn away. And that's something that we've mastered here at Unreal, and it does take a lot of time. A lot of hard work, but that's the right thing to do. That's one of our core values, is do the right thing. And as more and more larger brands embrace this, the costs will come down, the supply chains will be built. But we've been doing this, since day one of the company. Since our two founders asked the question, why the foods we love most have to be so bad for us, and we set out to prove that they didn't have to be. So we've been pushing this movement for many years and really trying to have a ripple effect in the industry. And it's really great to see other brands start to recognize that and make the hard choices to move away from what they've been doing for so many years.
Kevin, there's got to be part of this, though, that isn't good news for you. If Snickers all of a sudden turns around tomorrow and decides to put cleaner ingredients in it and reduce some of the fat content, increase fiber, they've got a lot of name recognition, more so than Unreal. Let's be honest here. Is this not a problem? Does it not create more competition for you?
Yeah, more name recognition for now. But no, it's a great question. And look, our mission is to unjunk the world, and our vision is to create a world where all food is 100% real. So if our category, the chocolate candy space, was all natural, every brand was using all natural ingredients, today, we'd see that as a win. Because we've been doing this for so long, and our real goal is to have a ripple of change throughout the industry. And then, it's really up to us to execute, to continue to do, great work and build our brand for who we are. But really, we're trying to, create that world in which all food is 100% real, and that's a success point for us.
Kevin, we're taking a look at input prices for pretty much every company we talk to right now, but in regard to your company, cocoa costs, really curious on how that's impacting your margins, what you're doing to respond to it. Is there going to be chocolate that's just going to have to be a lot more expensive moving forward for consumers, especially if they want to, as you say, be unjunked from the candy industry?
Absolutely. No, it's a great question. And the cocoa market has been truly challenged over the past 18 or so months here. We've seen extraordinary price increases in the cocoa world, and it's really difficult to swallow those increases. And a lot of brands have been really hurt by that. Our strategy has been really to lean in. We've been using real chocolate with real cocoa for since day one with our all real ingredient commitment. And our perspective on it is we're going all in. We're partnering with our retailers. We're getting to know our consumers better. We're really partnering with our suppliers and manufacturers to make sure that we are prepared for scale so that we can run through this moment of challenge and come out on the other side of it as truly the better for you confection brand out there, so that as those underlying macro trends for consumers continuing to crave better for you real ingredients, we're there, and we're taking advantage of that opportunity.
What are you actually doing, Kevin? Are you able to, for example, pass on higher costs to consumers?
We've done our best to avoid that, and can't predict the future. But we've really focused on what more we can do to invest in ourselves in a responsible way to accelerate our growth. And that gets to the point I said earlier around us doubling our business in the last 18 months and really running through this moment. And really embracing, the real cocoa, real chocolate that we continue to use as, some other brands start to take the cocoa percentage out of their products or take the cocoa integrity out of their products. That's not who we are. We never move away from that value of doing the right thing. And we see this as a moment to really test that value and have us lean into that to really, again, focus on our mission, focus on our vision, and how do we really build that world that we want to, be in.
Kevin, you've mentioned twice now that business has doubled over, I think you said, last 18 months. What does this mean in terms of your profitability right now? Are you profitable? Are you raising money? What is your capital plan moving forward?
Yeah, great question. We're a profitable business. We're not looking to raise money at this time. We're just continuing to invest in ourselves and invest in this amazing brand and, frankly, mission that we're building. It's been around for so long, Unreal. I've been here for over 10 years, so it's definitely been a journey, but an amazing one. And I think the people that really change the world and companies that change the world, it takes time. And we're in this amazing, extraordinary moment where we're seeing this inflection point of growth, and we're doing our absolute best to harness every single point of that.
Kevin McCarthy of Unreal Snacks. We thank you so very much for joining us this morning. Now, I want to bring you some breaking news as well. You have JP Morgan expanding their research capabilities to include private firms, starting with OpenAI. And in their first report on OpenAI, they do start to weigh in. They said it would be difficult for chatbot makers and the other ones to maintain a sustained competitive edge, which kind of explains here why they feel the need to get into this type of research. I would also say, Danny, it's interesting. If you look at the valuation of SpaceX alone, just even last year's valuation places it among the top 25 companies in the S&P 500. And banks like JP Morgan, Morgan Stanley, we know that they're trying to look at ways to make this market more liquid as their highest net worth clients try to get a bite out of these privately held companies.
Yeah, but it's so hard to invest in OpenAI. It's so hard to invest in SpaceX. To me, I look at this and I think, what is the point of sell-side research? Is it just feel good, send out vibes for your clients? It's supposed to be, I recommend to sell, I recommend to buy, I recommend to hold, and you make investment decisions based off of this. I kind of don't see how that applies in this scenario.
Right, there's got to be a lot more qualitative work being done here, to your point, because are you going to set a price target, or is this a matter of just telling you what they're up to so that you can understand how
they can justify their bonus.
Justify the bonus and maybe know what's going on with the stocks that are actually publicly traded these days, because they rely so much on the fates of these big private giants these days.
All right, well, let's get a check on where markets are faring at the moment. because we have seen the gains start to peter out. Look, we are only down 0.03%, but the NASDAQ is down more. Part of what you've seen is some of the gains of the bond market have also started to ease. We still are seeing, though, a fall of about just under 2 basis points for your 10-year yield, trading at 443, Sonali.
Really interesting moves in the stock and bond market. Sad to see that gain get lost, though. We're going to look at some single stocks moving this hour with Bloomberg's cross-asset reporter, Isabel Lee. We're taking a look at managed care providers. You're looking at Humana.
We have to start with Humana because shares are dropping 7.5%. That's the most since at least April 2017. So the company lost its lawsuit seeking to reverse cuts to its Medicare program bonus payments. So this is a blow to the insurer because they were really hoping the court would restore billions of dollars in revenue. So a Texas court ruled in favor of the government's motion to dismiss the case. They called Humana's claim, quote, premature because they said the company hadn't really exhausted all administrative procedures. And this is a big setback because Barclays in April, according to Bloomberg reporting, said that a win for this would double Humana's 2026 profit. So now we're seeing their profits potentially squeeze.
Sonali and I were also, speaking of stocks on the move, having a conversation with Chevron CEO Mike Wirth earlier in the hour. You could really just feel the relief radiating off of the CEO of the company.
That was a good interview, and he said that they were pleased with the results. So we have Chevron winning its arbitration battle with its larger rival, Exxon, and finally, they were allowed to close their acquisition of Hess. And the victory comes more than 20 months after this was initially announced, and the deal was big, around $53 billion. So quick background, Exxon contested the deal, saying that they have the first right to refusal because they already have a joint venture with Chevron. But this is a big win for Chevron. The stock has really been languishing since this deal was announced, and it's also an overhang for the industry. And the interview with Mike Wirth was really good because he said that now the road is finally clear and there's no overhang anymore.
And the frenemies dynamic is back as well. Yes. I was going to say, it's interesting. Chevron was up almost 3%. It's losing some of its gains, but, the market has also turned. I would say that Exxon is now coming out with a statement. We were asking about that Chevron-Exxon push-pull. Exxon saying that it welcomes Chevron to its oil project in Guyana, Danny.
He very much so brushed off any issue of it. Frenemies is good. Industry frenemies. It's exactly what it is.
Right. Yes, exactly. You're also watching another deal conversation underway. I keep on thinking we're in the world of the Gilded Age once again, and we're talking about railroads, which is very fitting for the moment that we're in.
So we have Union Pacific saying that it's exploring an acquisition with Norfolk Southern, and you see Union Pacific shares edging lower, and obviously Norfolk shares are up almost around 3%. So the setup could really rank as the largest deal ever because we have the #1 and the #5 North American railroads merging, and combined their market cap is around $200 billion. So obviously both companies are positive on the deal. So we'll see, but yet again, another frenemy merging.
Isabel, we thank you so very much for keeping an eye on it. This is a market, Danny, that's in love of the deal news that's coming out. You do see another 3% rise in Norfolk.
Yeah, and it also chimes with everything that you were reporting on for these banks, too, that investment banking coming back, the confidence when it comes to deals. So here you are seeing the concrete deals actually coming through that provides that tailwind.
Yeah, but they're giving it to investors, yet the stocks are not responding that well. And you could see it with Netflix being the biggest drag today on that S&P 500. And we're going to switch gears a little bit. We're going to head away from the market as you digest all of the gyrations under the surface. Coming up, we're going to talk about a tariff really to whine about. Oh no, the puns this week. Your glass of vino may be getting more expensive on Wall Street week. We're going to take a closer look at what President Trump's proposed tariffs on European wine could mean for the industry. Stick with us. This is Bloomberg Open Interest. And it's time now for our Wall Street Week conversation. President Trump's proposed 30% tariff on European wine imports is set to begin on August 1st. David Weston explores how the move could reshape not just imported wine, but the entire industry.
Ben Aniff is president of the U.S. Wine Trade Alliance. He has a shop in Tribeca that sells fine wine, which typically goes for over $20 per bottle.
Distributors and importers, even those, by the way, that represent U.S. domestic wines, about 75% of their revenue comes from imported wine. So that's one of the really interesting things about this. On the tariff front, all of the major domestic wine producing organizations, from Wine Institute to Napa Valley Vintners to Wine America, they're all against tariffs on imported wine because they understand their domestic growers, their producers, rely on healthy wine distributors for access to market.
Put another way, because state laws prevent domestic vineyards from supplying restaurants and wine shops, they need distributors. And the distributors rely critically on selling imports alongside their domestic wines. That's why those who import fine wines, like Victor Schwartz, and those who sell it to us, like Ben Aniff, have no doubt that tariffs will cripple their business, selling both foreign and domestic wines. But there's another part of the business, the value wine business, where a bottle or its equivalent typically costs less than $11. And producers for this segment, like Stuart Spencer in California's Central Valley, say they need protection from multinational companies bringing in cheap, subsidized imports that force American growers out of business.
There is a lot of what we call bulk wine coming in these big 20-foot bladder containers, and it is this bulk wine that is really undercutting California grape growers.
There's a lot of talk about the difference between free trade and fair trade. From your experience as a grower, but also from your dealing with Lodi, are there unfairnesses in some of the exports to the United States?
I mean, it's a completely unfair market. I mean, we are competing in a global marketplace. The European Union spends, over $2 billion a year between EU money and member state money propping up their wine sector. They are not only paying growers and vintners to distill excess wine and buy it up, but they're also paying them to plant new vineyards. And they spend hundreds of millions of dollars in market promotion all around the world, and the U.S. is the #1 target market. They also have trade barriers, so it gets really complex when you get in the weeds, but we are not playing on a level field.
Last year, California wineries, which make nearly 90% of U.S. wine, were stuck with more than 500,000 excess tons of grapes. Now, 77 million gallons of wine are sitting in storage tanks.
And you can still see some of the grapes on the vines from last year. We have thousands of acres of grapes that are being torn out right now. And we have small farms and family businesses that are up for sale because there's just not a prospect for them moving forward.
That was David Weston discussing Trump's wine tariffs, and you can catch Wall Street Week every Friday at 6 p.m. New York time. Coming up on this show, secretive Jane Street is in the spotlight, the glare of a global spotlight, thanks to a regulatory probe. More on that next. This is Bloomberg Open Interest.
Now, the quant trading giant Jane Street is being thrust into the global spotlight after a regulatory probe resulted in the seizure of over $500 million. For more, we are joined by the co-author of today's Bloomberg Big Take, finance correspondent Catherine Doherty. And you have been all over the Jane Street story. The fact that they have become so large that even in a year that they have surpassed Bank of America and Citigroup at their trading desks in terms of revenue. You went through bond documents. You followed a regulatory probe now. After what has been a fairly tumultuous 2025 so far for this company, how has the reputation been changing on Wall Street?
So that's what we're starting to see unfold. This is a firm that has been in the background. They're growing in prominence. They're making billions of dollars of revenue in the year. They doubled that revenue from 2023 to 2024. But now the way that they're doing that has been thrust into the open. So you have this probe out in India from the regulators that is releasing documents that minute by minute, hour by hour, they're showing not just the trades that this firm is inputting, but the amount of money that they're making doing it, the profit. And so you've seen across Wall Street, their competitors and just folks that are curious and want to kind of analyze how this firm is doing what they do, they're pouring through these documents. And it's such an unusual time because this is a firm that otherwise can just be, again, behind the scenes, behind a curtain, and operate in the way that they have been. They've been founded in 2000, so it's not as if this has happened overnight. They've evolved over time. What is different here is as you bring up the reputation, this is something that has been the talk of the town, really, in the last 2 weeks.
So of the revelations, you have the Securities and Exchange Board of India having a 105-page order in addition to the bond documents you went through. What are some of the revelations that your sources are latching onto?
So they're looking at both the size of these trades, the concentration at certain times of the day. There's a lot of questions around how they're doing what they do at the scale that they do. So I think that is probably the key difference that folks are looking at, is the amount of money, not just that the firm is making, but that the capital that they have to work with, the amount of risk that they're able to take is much greater than their competitors. And the banks on Wall Street that are under regulation, that they have to answer to also their shareholders. It's a completely different ballgame. But even amongst the market makers, the folks that are the peers of Jane Street, they're looking at this and they're saying, how is Jane operating and how is Jane market making that is a much different flavor than what they are? And so that's really like kind of the key questions that are being asked and analyzed across Wall Street.
When some of these things appear and their competitors can look at it, does it do anything to erode their edge? Do they need to change track on certain things now that you have some of these documents for view by the public?
I think that remains to be seen. That's something that I'm asking the street about. But Jane, in general, they are it's simplifying it, but they're providing a service. And so they can continue to operate and be a market maker. They're providing liquidity to the market. And also, just because this happened in India, they're across the globe. And each jurisdiction and each asset class that they're operating in, they're going to be a different player, but in many ways they're a key player just across the board. So many folks that I have talked to have said that they don't expect that Jane Street will pull back in a way that they're going to it's going to affect their business for the long term because of how prominent they've become, that strength is going to carry them through.
Catherine Doherty, we thank you so much for joining us today. That is Bloomberg's Catherine Doherty. Don't miss her story on Bloomberg.com and on the Bloomberg Terminal. Currently the most read. Interesting questions around how Jane Street makes money, as well as some details on how well they are capitalized. Let's go check on these markets before we let you go, because we are seeing a switch, a little bit of a reversal in this S&P 500, trying to keep in the green, but below that $6,300 level now. The 10-year yield hanging out at 4.43%. Long day ahead, though, still, Danny, and a lot coming up next week. Coming up on Monday, we have Rob Arnott from Research Affiliates, Gargi Chowdhury of BlackRock. After this rush of data we've seen this week, Verizon CEO Hans Vestberg. This is Bloomberg Interest. Have a great weekend.